Welcome back to the Strategy Shift podcast. Today, we're joined by Sue Schuster, a business funding strategist with bizfi.io, who helps entrepreneurs secure the capital they need to grow, scale, and navigate financing challenges. Sue works with business owners across a variety of industries, helping them understand their funding options and make smarter financial decisions. Thanks for coming on, Sue. We appreciate you hanging out with me and Tom.
Yeah, it's going to be a lot of fun, as always.
Outstanding. All right, I'm going to. We had a great pre-meeting, and one of the things that hit home with me is everyone's familiar with traditional credit reporting. You have your Credit Karma, you're checking, and you see what your credit score is, and then as a business owner, you get hit with like D&B hits you with a Paydex report, right? So there's your personal credit report, and then you have your business report, and you told me there's actually a third one. Can you explain the difference between the three and why they're important?
Sure. So your personal has Experian, Equifax, and then TransUnion.
Yes.
Yes, because I don't do that one very much. But then on the business side, it's Dun & Bradstreet, Experian Business, and Equifax Business. They all have their own. So just like on your personal side, there's three. On your business side, there's three. But it's now changing a little bit from just Dun & Bradstreet, who's the OG in this space. And now it's changing to the SBSS score, which is a combination of your business credit score and then the owner's personal credit score. That is where the industry is going right now. So it's almost always looking at both. You can get funding on just the business side. You can get funding on just the personal side, but usually they are linked in some sort of way.
Follow-up question. There's companies out there that are preaching you need to separate your business and personal, right? And let's help build your business credit score. And this third option is kind of like leveraging both. Is that correct?
Right. So that's what the credit bureaus are now, like the lenders are now looking at. The lenders are looking at that. So now we're talking about you make your free Dun & Bradstreet score, and then they want you to subscribe to something because they want money out of this. A lot of things don't report. It's actually a reporting problem more than anything else. So you have, okay, I'm going to pick on some banks. So you have your Wells Fargo bank, whatever. That one's not reporting. You have your credit union in your hometown. That one's not reporting. There are only a few banks that report. Why does not everybody report? Because it costs them money. They don't want to report. So Amex, you got one Amex card, the black card, that's really, really, really hard to get. That one reports. Everything else reports to the SBFE. And that is an intermediary stage. Like, this is a broken system. That's kind of what I'm getting at. You need to know what reports. Things that report. Here's some free advice. Gas cards, they report. So get yourself a business gas card. I don't drive anywhere. I'm a solopreneur. You go to the grocery store. Just pay it off personally. So gas cards report. Quill, Granger, Uline, they all report. Go get yourself a net 30, net 60. Buy diapers. I don't know. It doesn't matter what you're buying. So those are just two streams of revenue that you can kind of credit, like vendor lines that you can use and build your corporate credit, even if you're not a business that has a lot of inventory or you don't really use these things, but you buy toilet paper, so you might as well build your corporate credit on them.
So I'm a sports guy, and I look at it like business, like owning a business, almost like playing a sport. Like if we're looking at that type of like mentality, Sue, like what's the dashboard that I should set up? Like how do I look at a number and like if it's good or bad, how do I know? And then what the hell do I do with it to improve it?
Okay, so I'm just going to talk on business credit. I'm not going to talk on personal credit. So business credit is out of 100. But then there's different stages of it. There's different tiers. You have to get to 80 out of tier 1 to go to tier 2, and then you start lower, and then you go higher, and then you get to tier 3, and then each thing opens different cards. Like Lowe's and Home Depot have a card that you can get on a business. However, you already have to be in tier 2 credit to go ahead and qualify for the card. So what you should be looking at is not how much you make. It's how much you spend and then pay off. It's your bill to spend money and pay it off. So if you even get 100, 150 bucks that is actually reporting and you use it every month and you pay it off every month, that's how you grow this.
Makes sense. So is it good to pay things off? I mean this sincerely. Good to like, let's say, pay it off in completion every single time, or like a lot of people are under the impression that you should be keeping like a credit line opening and making consistent paying payments towards it. Does that make sense?
It does make sense, but we're not looking at a term loan. We're not looking at any of that. It's all credit card revolving debt type funding. So yes, pay it off.
Yeah, just to, like put it on the card or whatever and then pay the whole thing off.
Correct.
Yeah.
Correct.
And Sue, you talked about obviously you're an expert in financing, but what I found really surprising is that most small businesses don't use traditional banks. Why aren't they set up for small businesses?
Banks are very debt averse. And they're risk averse as well. So if you go into a bank and you get your SBA loan and you're super excited and you leave, but they have, if you fail as a business owner, you might lose your house. So they've really taken on no risk. So I mean, if you don't fit in their box, that you can't get the SBA loan with said bank, your bank you've had a relationship with, you're just a number and they don't really know you and don't really care and you don't fit in their box. So you haven't been at some flags. You don't have enough time in business. Banks usually 5 years. Other things, you don't have enough revenue. Again, they want 100% chance you are going to pay this back. If you are kind of risky and maybe don't have enough revenue that they're looking at, that you haven't hit the threshold, they won't say it's okay. Maybe your FICO score is not high enough. Maybe you don't have a 750. You only have a 680. There's another one. And then another thing, banks often, like when you're going for your loan, whether it's a term loan, line of credit, whatever it is. By the way, line of credit is the hardest to get and the most useful, but the hardest to get because they have to put that money aside. So you get $50,000 line of credit, you only use 2,000 of it, they're only getting interest on 2,000 of it, but they have to put 50 aside for you to use maybe in the futures. So they
So on
don't.
a high level, so is that the difference between a line of credit and a term loan?
Term loan, yes, they give you the whole 50,000. Here you
Right.
have to take it. And then you use somebody like Tom to say, this is how we use it wisely and to grow the business. But a line of credit, you only use it as you need it. So that's the major difference between. So term loan is easier to get because they know they're going to get their interest on 50.
In a line of credit, they're only going to get the interest and when you're leveraging, when you're accessing it.
Correct.
Yeah. The LOCs are fantastic. I use that for my commercial cleaning company. I mean, anytime that you had to float payroll or like put a bunch of supplies out and your AR and AP didn't line up, right? It just gave you the gap and you could use only what you needed at the time. It's fantastic.
Yeah, line of credit is useful for every company. And a good rule of thumb is if you need money, it's really hard to get. Get money before you need it. So go ahead and establish that line of credit. And then banks also take a while to get any of this thing through. So you give them the information, they wait 3 weeks, they call you back. Hey, we need more information. Wait 3 weeks, call you back. We're missing this. So working with somebody like myself can get these through a lot quicker. And then the bank has like 1, 2 options. And we have several. Lots of them are banks. We use banks, we use private offices, we can use private equity. I mean, we have lots of options. So coming to somebody like us is not the slam your face in the door. No, you don't qualify. It's, hey, this didn't work, but maybe we should try this.
Yeah. Now you mentioned like get the money before you actually need it. Can we talk a little bit more about that?
Sure. So if you've got your revenue coming in and you're looking at it going, I can pay all my bills and I'm doing really well and I'm never going to need funding ever. And then, stuff happens. COVID happens. I don't know, they change the laws, like things that are not in your control. So if you have your line of credit already, or you've established a great relationship with a lender like myself, like you use a little bit of things, like you got a small term loan, but now you're establishing your business and your credit with a certain entity, then you can come back later. But yeah, when you need it, hey, I'm not making enough in payroll. Well, no, I don't think you can pay it back, so I'm not going to give you any money.
Right. And you also talked about some of the financing mistakes. So we talked a little bit about the merchant cash advances, why that's not necessarily a good thing. Can you expand on that?
Sure. So a merchant cash advance or an MCA loan are those people who are contacting you already. Like I might put stuff on LinkedIn but I'm not going to call you and say, "Hey, do you need money?" But these merchant cash advance people are very aggressive, and they'll say, hey, I can get you $100,000, just push this button. And probably they could give you some of it, like 20 grand, and then they promise you the other 80 grand in like other funding, and that never comes to fruition. So merchant cash advance is usually a weekly or daily payment, usually in the hundreds or thousands, and they stack themselves on top of each other, so they can go third, fourth, fifth position on each other. Yeah, and then if once you get past two, if that's you as a business owner, let me know. But that's usually time to file Chapter 11. It just gives you breathing room. It doesn't fix it. It makes it worse. And I will often tell people, I can get you this money, but it's going to actually make things worse for you.
So you being like an intermediary, Sue, like helping these business owners get the cash that they want and making the wise decisions and how to get it, what are some of the big qualification questions that you're asking your own clients and saying like, what is the right way? Or maybe even saying like, maybe this is not a great decision in the first place. Like, what are those qualification questions you ask?
So I asked, well, time in business, why do you need the money? Because I'm going to take them to the source that would be best for their situation. I need the money for equipment. Oh, great. We're going to go to equipment financing. We're not going to get an SBA loan or a growth term loan to get equipment, because our rates would be better with just going equipment. And equipment can be things on wheels. It can be walk-in freezers. It can be dental equipment. I mean, just stuff. So it's always like a conversation. What do you need the money for? Oh, I need it to hire somebody. Okay, now we need more growth term loan. I have a huge AR. Oh, well, maybe we should do factoring, which is not a loan at all. So maybe we should do that. Then we can do business credit cards. So it's always a conversation. How long you've been in business? What do you need the money for? How long do you think you need this money? How much can you afford? And then we start getting documentation, which would be tax returns, last 6 months bank statement, proof of
But
their
you're
FICO score.
you're kind of pushing them to use the capital strategically.
Of course. I mean, being a small business owner myself, had 18 years of swim school experience, small business, wore all the hats, did all the things back before there was coaches, consultants, and everything else. Um, so I want to sleep at night. I want to win, win, win. I want us to win, and we can make money as brokers. I want them to win because now they have a more leverage and breathing room and can do the thing that they want to do. And then whoever referred me, I want them to win too. So I mean, I want no losses.
Yeah. And as for like preparation, right? Like I'm assuming that you probably trip across a lot of people going like, we can definitely get you money, but like your money can come to you a lot more like a lot more free of risk if we do X, Y, and Z first. Does that happen quite frequently and you have to do some prep work before you start hunting for money?
I don't do the prep work, but I'll give them to somebody who does. So CFO's my best friend. Coaches,
Mm,
my best friend. So we want a package that looks clean and tight when we get it. So they need to know their P&L. They need to know their balance sheet. If you don't know your numbers, you don't know your business is something I say often.
mm.
Um, and business owners, they're good at their thing, their widget, whatever it is. But then the bookkeeper is good at bookkeeping. The plumber is not usually.
And
Yeah.
there's also the big difference between bookkeeping and preparing and utilizing a strategic CFO.
Right. Yes, they're all different. Your CFO, your bookkeeper, and your coach are all completely different, and they do different things. You need all three.
Mhm.
Yeah. What do you tend to find right now, Sue, for your clients? Which ones are like the best one for you? Which ones that come to you and you're like, oh my gosh, like this is a prime fit for like really leveraging a good strategic partnership?
So, equipment financing is the easiest because the equipment itself is the collateral.
Mm,
Since that have been in business more than 2 years, it opens the floodgates on things you can do.
yeah.
Your startups, the people looking for private equity, by the way, private equity is really hard to find. So it's not a band-aid, it's not a quick fix, and you're giving away equity. We could all talk about that. Don't give away equity, keep your company. Um, and the other thing that I get a lot of is rate. They're like expecting 3, 5% interest, and that's not a thing anymore. I mean, prime is over that. So That's not where it is. So, and then if you don't personally guarantee it, or it's not guaranteed by something, then the rates are easily in the 15. And your MCA loans are like ridiculous, 40, 50, 60%. So that's like you borrow $1,000 and the next day you owe 1,500. I mean, that's how quickly those go up.
Yeah, so
Mm.
how would that even make sense? But borrowing something at 40%, is the margin that you're going to use that money for so great that you can absorb the 40 points?
It was easy to get, and they don't look that far. Some of them do, and they go, okay, I have this huge project. It's going to end in the next 2 months. I'm going to get a bunch of money. I'm going to pay this off. Okay. There's a few people who do that, but mostly people just think of it as like credit card free money, and they don't calculate the rest. And
Or literally closing the gap on like just a bad time and need to like bridge it. You know what I mean? Like, let me
right,
just do this and I'll be okay. You know,
right. If they have an out,
in payroll once or twice, or like not making a payment on something that's critical to business operations.
right, but they should have an out. I'm going to get a bunch of money and pay this off. It is not sustainable, especially once you get two or three or five.
That's a
Yeah.
prelude to bankruptcy, is what you just said, right?
It is. And the industry knows it. So when we do a lot of fintech, so we can take bank statements, everything, roll them into a program, spits out summary. MCA low days are big things on that. Like once we look at how much percent of their revenue or debt is going to MCA loan, that can squash a deal. Often we're using not high interest, but higher interest products to knock out the MCA loans so that we can go and get better financing later. A lot of this is staggered and on top of each other. We get this type of financing so we can go and eventually get that type of financing.
So if you're a small business owner, maybe this is like your first time asking for like let's say a decent amount of money, you know what I mean? And you've not even explored going to the bank yet or something like that. Like what's the thought process, Sue? Like do they even stand a chance trying to learn it on their own and like trying to make a right decision? Or do they really need to go seek somebody like you guidance first? Where do we go to like actually really think through this and get some suggestions or guidance on how to make the right choice?
I would say your CFO or your business coach. That's really where hopefully they know. If they don't know, then they should contact me. We should have a relationship, all that stuff. But honestly, I don't have time to really sit down and educate them. I need to get a full package. I need to move it on to the lenders, try this lender, that lender. Most of what we do is a soft pull anyway, so it's not a hard pull. So I love to educate, I love to coach. However, I don't really have the time.
Yeah. Yeah. I like that
But,
delineation. Yeah.
well, like you said, there's certain basic things that every business owner should do as far as their numbers before they even talk to anyone, right? They should understand, you said, their P&L, their balance sheet, their statement of cash flows.
Right. And if you don't know these things, that's okay. We all didn't come out of the womb knowing these things. We learned them probably the hard way. So ask questions. Don't feel stupid.
Awesome. Well, I know we're coming to our end of time here. So we ask every guest that comes on the podcast a similar question at the end, and that is if you could give the small business crowd one, two, or three takeaways from today, what would it be?
Know your books. Give money before you need it. And ask a lot of questions.
I love all three of those. That's fantastic. Well, Adam, you want to take us home real quick? Sue, this has been amazing, and I really hope that this helps a lot of other small business owners out there think about how they're going to access money and continue growth and scale on their side. Adam?
Super. Yes, so this was fantastic. And the old joke, the banks, they will loan you umbrellas when it's sunny.
Right, right.
But this was fantastic. So what's the best way to reach you?
Probably my LinkedIn account. You have
Okay.
to throw in another name in there. That's not my fault. So it's Sue Pantano Schuster. Or my email, which is sue@biz-fi.io.
Outstanding. We really appreciate you having on the show. And guys, I tell all our guests, I really appreciate you hanging out with Tom for a half hour. It's hard.
Yeah, the patience is wonderful.
Thank you.